Hey, it's Nicholas Armistead with Broker LLC.
And this is Quentin Burks with Movement Mortgage and Opelika.
So, first of all, I want to welcome you guys to the Foundation First podcast. So, man, what you kind of want to talk about today, man? What you want to talk about today? What you want to hit on?
Let's talk about our client that we were working with this week. She has some equity, wants to use it, didn't really have an idea, figure out which direction she needed to go. And I don't know her whole situation. So let me hear her story. Her and I have only had a couple conversations. So let me hear her story, because I've made some suggestions based on the conversation we had, but I want to hear her whole story, kind of how we got to this point of wanting to use some equity and possibly selling a home or whatever.
Yeah, so I met her back in 2019 through, actually it was another mortgage lender that introduced me to her.
Okay.
She was a first-time home buyer. She had recently just had her daughter. I think she was 3 months at the time.
Oh wow. Okay.
So she bought her home in 2019. We stayed in contact since 2019, and then just recently this year, she reached out to me and kind of said, "Hey, I'm maybe thinking about selling my home."
Okay.
But she kind of gave me a heads up, like, "Hey, there's some things that need to be done with the home that I might need to get done, and I really don't want to tap into my savings or anything like that. So how can you potentially help me, problem solve around this and possibly getting these repairs done, but I don't want to empty out my savings."
Right.
So I reached out to you. I told you her situation as far as, she's thinking about selling her home, and that's how we got here.
Okay. And so I'm always intrigued when people decide to go ahead and purchase their home, because it is an investment, whether you look at it that way or not. Yes, it's where you live, but she's not required to take money out of her savings now, because her house has done that for her in equity. And I think that's such a cool, you know what I mean? People don't think about it that way, but a lot of times you can't save money as fast as your house gains value.
Yeah.
And the difference between what you owe and what your house is worth is the equity, right?
Yeah.
So she's able to use that instead of having to take money that she worked hard to save and use that to get her repairs done, using the equity line of credit. So a lot of people, the term equity is thrown around a lot, but as a first-time home buyer, people that are going to be tuning in here may not necessarily know what that means.
That's
but
true.
That's money that you can use. No, you can't go to the bank and get equity, in a check, but you can borrow off of your home's value. Yeah. And this is going to be a great situation for her, because I did do her equity application, and she has excellent credit, and her home is worth a lot more than what she owes on it. So she has, in excess of maybe $100,000 that she could use to do the repairs. And do you think her repairs are going to come?
No,
it won't.
So we actually looked at it, because I gave her two scenarios when I to look at the house. As is,
okay,
that's the way the house was, with nothing being done, which would cost no money out of pocket. Or I gave her a scenario to where if she did everything and got the house in pristine condition, what that dollar amount would be.
Right.
So I think roughly the repairs, everything she needs to get in, will probably be around about $10,000-$15,000.
Okay.
$10,000-$15,000. But that $10,000-$15,000 is a difference of probably about $60,000 in profit.
That's huge.
So I think at the time, I got it on my phone, but when I did the as is, I think it was right around 230 to 240, what you can do as is with no repairs. And that's just, I don't know what somebody might not offer that, but based off what I looked at, based on the data, it's like 230, 240.
Okay.
And then honestly, like I said, after repairs and everything, you're looking at 330.
That's a big difference.
Yeah.
That's a big difference.
It's a big difference. So, and it's a good thing to, like I said, she don't have to empty her savings, anything like that, to where she can just use the home equity line of credit or whatever she's going to use to do those repairs. And then when she sells the home, because the home equity line of credit is actually a second lien on the property.
Right.
So when the person buys her home, they're going to pay off that lien as well as the primary mortgage.
And so in situations like that, it works out great, because yes, it is a second loan, but it's serving a purpose.
Yes.
So she's not going into debt, so to speak.
No.
She's using a resource that's going to allow her to increase the value in her home, to sell it, and maximize her profit. So her home is located here locally?
Yes, in Opelika.
Okay. So that's another great situation where, you know, we know this area. You're certain, you know, that the investment that she's going to make is going to improve her value. You're not just taking a shot in the dark. You know what I mean? Saying take these funds to put it in here and then hoping that it brings the value. So she's going to make a good investment for the second time, and then she's going to be looking to purchase a new home, or?
Well, I think she's holding off right now.
Okay.
I don't know really the situation or whatever, but she's not going to purchase right now, but she will be in the future.
Okay. But regardless, she'll be able to, you know, get her property improved.
Yeah.
So even enjoy the repairs there while she's living there. So
but she's finna make almost $100,000. So I mean, I think it's a win-win for her.
100%.
You know, whether she's paying off debt, going on vacation, whatever it may be. Like if she never took the first step of buying that first asset, she wouldn't be where she's be able to make the money she's going to make now.
And I think a lot of times people don't have the foresight to see that, but when you meet with us or any professional really that knows that, and if you can build that trust to where they, you know, believe that you'll guide them, even if they can't see it, taking the first step can allow you to take advantage of something years later that you never even knew would have been an opportunity. So I get excited when I see stuff like that, man. So I'm really happy for her. And like I said, she's in a great situation.
Yeah.
It's always good when they have done the things they need to do so you actually can help them.
Yeah.
We want to help everybody, right? But everybody isn't in a position for us to be able to. But when I got her application in, super nice person too. Very thorough, you know, has her ducks in a row. I mean, instant approval essentially for the product that I was looking at using for her. So she was just waiting on the contractors' quotes and estimates like that. So once those quotes and estimates come in, she'll be solid.
So let me ask you this, because you see a little bit more than I do. Have you ever came across some situations to where maybe some of your clients maybe had some equity and they weren't educated on it and maybe missed out on some key opportunities, or we were talking about equity. Like, have you kind of seen anything interesting on your side when it comes to equity, like with past clients or people?
I'll tell you a really good story. Right. So it's actually a family member purchased a home. I don't even remember when. It was a while back, prior to 2019, I believe, maybe early 2018. It was owned by a previous investor, so he got a really good deal on a property. It's actually in Georgia, really nice house. Years later, I'm of course making payments, paying the balance down. Years later, wanting to tap into the equity. Might have been in 2023, wanted to tap into the equity. Things changed in his life, you know, job situations, several different things that needed to tap into some of the equity, but his situation wasn't the same as it was when in previous years. So a lot of times with equity, especially lines of credit, you can open up a line of credit similar to a credit card. You're not forced to use it, but it's available for you. So I always try to encourage people to access your equity or make it available to you when you don't need it. It's always easier to borrow money when you don't need it. But he waited until he got into a pinch, needed. He had over $200,000 in equity. Credit situation, job situation, a little different. Didn't qualify for nearly as much.
Oh, wow.
And so wasn't able to tap into it. Now the only way to tap into it is to sell the home. That's not the option that he wanted to use. So kind of missed the opportunity there. So if I were to ever tell anybody about equity, and if they know, if you find out, you send out your market report, you see, okay, $100,000 in equity. Oh, everything's good right now. We don't need anything. You know what's available to you. You access it if you can. On a line of credit, you know, preferably not a fixed end where you have to take the money, but similar to a credit card, make it available to you so that if something does come up, a repair, you know, some emergency that you may need to, you know, access funds quickly, and then you can write a check off of that line of credit. And then of course you'd only be paying back what you borrow. So that's one of those moments where you looking back and he wishes he would have done it, but he didn't know, you know what I mean? So I think it's important for us to have this conversation. So when you talk to your clients, remind them when you send out those market reports, even if, I'm not looking to sell, Nick, or I'm not looking to do any repairs. Well, you have this amount of equity. You may want to talk to your banker about what you can do to tap into it, to just make it available to you so that if you do decide to use it, you can.
Mm-hmm. Have you seen you said, well, key takeaway that I just heard you say was, always be ready, so you don't have, like, always be ready. So even if you don't need it, just be in a position to where if you need access to it, you can access to it, because like you said, like, things happen in life. You might lose a job,
Right.
things might happen, but whenever you need it, if you're not in a position to access it, you might lose your access.
Absolutely. And then that's a terrible thing, because I mean, you're sitting here, you got $200,000 and you need 50.
And you can't even get it.
And you can't access it unless you sell your home. That shakes up your lifestyle. So that conversation we had after the fact, of course, things have gotten better since then. Went ahead and did what he was supposed to do. Doesn't need the money.
Mm-hmm.
Go ahead and access the line of credit. So now the next time life throws something at you, I know I have a safety net, or just access a resource that I can use. So for first time home buyers, making an investment in a small, starter home, that starter home could be a resource for you years later. You know what I mean? Whether that's converting into an investment property, tapping into the equity to purchase something else, buying a car for your child, whatever you choose to do with it. So multiple uses, there's multiple uses for equity. But one of my favorite, a lot of people don't realize, I was talking about purchasing a home and, it turning into something big. So let's just say, for instance, you purchase one and wind up paying it off early. People do that, making additional principal payments, and now you own the home outright.
Mm-hmm.
And you decide you want to move to a different home, but you don't want to sell this home. It's your homestead. You don't want to sell it. You want to keep it. But you have a young child or a family member that does they want to move into the house. So let's just say you do want to sell it, but you want to sell it to a family member. So you're not looking to make a profit, right? You want to help somebody. You can gift equity as well. So it's interesting. So instead of, typically we have a down payment, right? For homes, you have to put money down when you purchase a home. Even if you're using 100% financing, there's always going to be some cost involved. So only family members and select people can gift equity, but it can be transferred to you to cover your down payment for a purchase. So instead of it being a line of credit, in the traditional sense, you can actually gift it to a family member to cover their down payment. And I've done a couple of those, since I've been lending.
All right, so let's paint a real picture here.
Okay.
All right, let's say I own a house that's $300,000. I paid it off.
Yep.
I don't want to sell the house, but I want my son to have the house.
Okay.
So how does the gift of equity work in that standpoint?
Okay, so now let me back it up, because you would have to sell it. Let's say you do want to sell it, but you're not looking to make a profit in the traditional sense. So it's worth $300,000, but let's just say you only paid $200,000 for it.
Okay.
So you got $100,000 in equity. You don't need the money; it's for Nash. You know what I mean? So what you're gonna do is, instead of having him put a 20% down payment, you got $100,000 in equity. You can gift him all the costs associated with the loan, so he can get into the home without any money out of pocket, in a sense, and only finance the portion that you're selling it to him for. You can only do that with family members, because you're gonna be selling for far less than market value.
Got you.
And that's the only way that it works. So
Got you.
It's really interesting and a great tool. I've done it for family members before. It works with land as well. When somebody they own, portions of land, you can gift it to your child and they want to build a house on it. They don't have to have a down payment now, because now the land is the down payment. So this is a long conversation, and we may have to make this episode too. But equity is an excellent tool, can be used multiple different ways. So purchase homes, lay your foundation first. You know what I mean? Go ahead and get into your home, so that equity is a tool that can be available to you later on down the road in a multitude of different ways. I know, I can tell you wheels turning. We haven't talked about this one a lot, but we kind of jumped into it. But we can wrap up this episode. We might have to make a part 2, so we'll talk to our director about that and see if he's willing to take us into part 2.
Okay.
And we'll end it here.
Okay. Well, before we end, we had a couple questions from the last videos people had kind of want to answer. So, did you have the questions?
Yeah. So the first question is, how do I know if a home is being priced fairly?
Okay, so the question is, how do I know when the home is being priced fairly?
Yeah,
Okay.
that's definitely a question for you. So
Yeah.
you can take that one.
So I would say fairly, I would say priced at market value. I wouldn't necessarily use the same term fairly. I would say priced at market value. Um, the reason the way you can look at it is by your agent doing what they call comps, which is comparables, is looking at what have sold recently within the past 30 to 60 days in that area to see if that price is comparable to what's been selling. Now, like right now in the market that we're in right now is very unique to where you really want to do that because you have a lot of sellers out there right now that's inflating their price. They might, because you may have a house on Maple Street that's on the market for 400,000, but all of the homes that have sold only sold for 350, and they only got to market it at 400 because they want 400 for it.
Right.
But the market value saying is 350. So a good agent can actually, do their research, do their data, and they can actually show all this to you, so you know.
How do interest rates affect my monthly payment and overall affordability?
Okay.
So how does interest rates
affect my overall monthly payment and affordability?
I think that one for you, my bro.
Yeah, that's for me. So it's the one of the largest determining factors in it. So the rate of interest that you pay is gonna directly affect your monthly payment.
Mm-hmm.
The lower the interest rate, the lower the payment. So during the lowest interest rate environment that we were in 4 or 5 years ago, a lot of people were able to qualify for more house because the rate of interest that they pay back was lower. So as interest rates go up, affordability can definitely go down unless your income is going up with the interest rates. So income and debt are going to be the two key factors that I'll use to determine your affordability for homes. So I always tell people you can just about calculate how much home you can afford on your own if you use a simple calculation of how much current debt I have versus how much income that I bring in, and we use gross. So that's a simple calculation. You won't get exact, but you'll get really close to determine what your debt to income ratio is, how much debt you have versus how much income you bring in, and you can add in what your potential monthly payment would be to determine if you would qualify for that home price. So interest rates are a key factor. So when interest rates are lower, affordability for most people goes up. They can buy a larger or more expensive house. And when interest rates go up, you probably, some people now that purchased 5 years ago, if they purchased their same house now, it would be much more expensive. So
I got a question for you. A question after the question.
Okay.
When you're looking at interest rates, I guess when y'all are looking at interest rates when it comes to all these determining factors, like is it really that major of a spread of difference from somebody that has no debt with the perfect credit score to someone that's pretty much just scraping by? Is it like, or is it a complex? Like is it very complex, or is it pretty simple? Or I don't know. I mean, this is your world.
It can be complex. The biggest thing is people think that a difference in a 6% rate and a 6.5% rate is huge, and it sounds big, but it really doesn't affect it as much as you think it would. But a person with no debt and a person that does have debt, that would come into play in a much larger, on a much larger scale than just the interest rate difference itself. You know what I mean? So the rate does play a factor for sure in affordability, but your debt likely plays a larger factor, you know what I mean, in your affordability than the rate itself.
Okay. All right. Well, cool, man. Well, thank you guys for joining us, and as always, man, please, like, comment, subscribe, and please comment any questions that you guys want us answering or whatever, man. We're happy to answer the questions for you guys. So we're looking forward to the next episode, and we'll see you guys next time.
Till next time.
Peace.
See you.